This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
All right, everybody, it's a new year, and no American technology company has been as heavily as Apple on the economic independence of China and the United States. Apple, Tim, it's simple. It needs Chinese workers to make its iPhones and Chinese consumers to buy them.
So this would seem to make the deteriorating relationship between the two global superpowers, the US and China, uniquely dangerous for Apple. Remember, Biden launched an aggressive campaign to keep China from developing advanced semis and called Chinese President Xi Jinping a, quote, dictator. And then Xi pursued a strategy to limit China's reliance, Carol, on Western-made technology. But
back and forth.
Shares of Apple were up 50% last year.
Yeah, they did really well. So let's get into it, because while the company's floated above the geopolitical tumult so far, Apple does enter this year, 2024, in danger of getting dragged into it. So writes our next guest. Not a guest. He's a friend of the show, friend of the family. Bloomberg Businessweek columnist Max Chafkin, who joins us here in our Bloomberg Interactive Brokers studio. His story, by the way, in the new issue of Bloomberg Businessweek, which is already, by the way, the story available at Bloomberg.com/businessweek and on the Bloomberg terminal. Happy New Year.
Happy New Year.
It's going to be Happy New Year for Apple.
Well, look, Apple is a big and powerful company, and what we're talking about are certainly challenges, but probably not existential challenges. I mean, when you take a few steps back, there are a few companies that are as sort of bought into the idea of U.S.-China relations being fairly warm. And that goes back decades. When you talk about Tim Cook, where did he come from before he was CEO of Apple? He was essentially the architect of this supply chain, the supply chain that relies on these big outsourcers, most of them operating factories in China, to manufacture phones, and relies on a market, a market that has grown tremendously and has done really well by Apple over the past few years. You might have thought during the Trump presidency, Trump, a lot of anti-China rhetoric, a lot of rhetoric about globalization. Apple did great. And one of the reasons Apple did great is because although the trade war did not affect Apple, it did affect Apple's competitors, primarily Huawei. Mm-hmm. So for several years, Huawei was essentially frozen out of the market for high-end chips. It had, in 2019, Huawei actually surpassed Apple in terms of handset sales globally, in terms of units sold. And then it basically fell off a cliff because it lost access to semis, to the high-end semis. And what happened last year is that Huawei, basically out of nowhere, and we've talked about this before, launched this new phone, the Mate 60 Pro, that has a chip that is, although it's not quite a state-of-the-art chip, it's a lot closer than it was. That phone has sold very well. Huawei is bouncing back, and that is creating problems for Apple in China at the same time that the Chinese government is introducing new restrictions that the U.S. has characterized as retribution for our own restrictions. China has been sort of opaque about what they're doing, but it seems like, according to Bloomberg reporting, that many Chinese workers at state-backed companies are being encouraged or told or required not to bring iPhones to work. So you have these two sources of pressure. One is competition, the other is government regulation, and they're biting Apple, in a very important market.
Max, I think a big part of this story also is the fact that the mobile ecosystem in China is not as sticky as the mobile ecosystem in other parts of the world. So here in the US, if you're an iOS or an iPhone user, your next phone is going to be an iPhone because you're like in that ecosystem. You have all the apps. But then in China, you have these over-the-top payments apps that work equally well, whether you use an Android or whether you use an iOS device. We don't have that. They don't have that stickiness that we have here with like iMessage and other parts of the Apple ecosystem. Well,
and a big point, when you think about what is appealing about an iPhone, obviously part of it is the hardware. It's very beautiful, works fast, good chip, so on. But the software part is important also. And of course, software in China and these cloud services are regulated differently. Chinese users may not have access to all of the cloud services that U.S. users have access to. So that's another factor. And of course, there's been a lot of sort of media coverage around this issue. In China, there's talk of sort of patriotic duty to buy, phones made by domestic companies, just as there is, I guess, to some extent, in the U.S. But until recently, that hasn't had much of an impact. And one reason it hasn't had much of an impact is because you haven't had really strong competitors. But now, talking to analysts and so on, the competitors are getting better. They're closing that gap with Apple. At a time when the government may be more interested. The government has long been interested in sort of reducing the, influence of foreign-made technology equipment, but where the government now seems to be sort of doing something, acting on that interest.
So does Apple have to be worried about China, especially, consumers wanting their devices or being able to do it? I feel like we have had bull-bear scenarios as of late in the last week or so, where there's some concerns about the uptick in China, specifically of the iPhone. So does Apple need to be worried? I mean, it also employs a lot of workers, which is a good thing for China.
So when you hear what Apple's saying publicly, what they're saying is, they're not seeing this. They're not worried. They've sort of signaled that the softness in China was not, in the most recent quarter, was not related to this iPhone issue.
And they still sell a lot.
And they're selling a lot. And we write in the story, there are big lines, at Apple stores. The fact is that this is a device that whatever the government says or does, and whatever's happening politically, is popular with consumers. People like it, and the same way they like it here. So that is all stuff that is going for Apple. And again, when you look back historically, we've sort of talked about this, and these warnings have been swirling around for like a decade, and Apple has basically done well, has continued to grow its sales in China. Now, sales may be plateauing to some extent, but now people are raising concerns that we may be turning some kind of corner.
Can you talk a little bit, Max, about how this is a function of Tim Cook before he was CEO? I mean, this is a guy who was a supply chain expert before he was tapped to become interim CEO and then, CEO when Steve Jobs died. How did he set up Apple in China?
Well, and this is like such a fascinating thing because people think of Apple as this design-first company, and you might think that the successor to Steve Jobs would be another, head in the clouds, creative type. And of course, that's not what Tim Cook is. Tim Cook is a practical-minded supply chain whiz. And, it's worked incredibly well when you look at the number of devices, the way they've been able to squeeze costs to make this thing cheaper, to maintain their profits. I mean, a huge percentage of the profits in the smartphone industry generated by Apple. It's all kind of worked well. Then again, it's built on a vision of the world that is changing, and that will continue to change, assuming that the U.S. and China tensions between those two countries continues.
On those supply chains, you're right. The supply chain diversification, right? Because Apple is looking at other places, but might be, well, it looks like it's a way to reduce Apple's exposure to geopolitical blowback. It may be having the opposite effect. And you're right, Apple's a major employer in China, and the government crackdown on iPhones could be seen as a warning about moving jobs out of the country. That part of the story just kind of blew my mind because I don't know that we've really thought about it that way.
Yeah, so that's the thing. I mean, Apple sort of seems to have dispatched executives. Tim Cook flew out there at the beginning of 2023. A senior Apple executive made public comments, kind of a rare interview with state media, talking about the kind of joint relationship between the two countries. Apple's really interested in sort of promoting the idea that, hey, it's been a really good employer in China. Yes, it is interested in diversifying its supply chain, as are many companies, of course, because as we've seen with COVID and so on, there are reasons for that. But it's hard to escape the sense that they're in a bit of a box. They have to, or that they at least have to walk a line where they want to diversify their supply chain. They're trying to make more iPhones in India, both for reasons of diversification because they want to reach that market, while at the same time trying to make sure that they keep those relationships in China that Tim Cook and this company have spent decades building intact. They definitely can't just turn off the iPhone factories in China. China's going to be important to Apple, for many years going forward.
God, it's fascinating, right? It's like we'll see what happens in the new year. It would hard to be Tim Cook and kind of juggling it all. Max, great piece of carry out into the new year. Max Chafkin, columnist at Bloomberg Businessweek, coming up in the new issue of Businessweek. It'll be out next week, but it's already on the Bloomberg terminal at Bloomberg.com. Max, thank you so much. Happy New Year. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
We've got one of the most read stories, Tim, that we really want to get to.
Yeah, it's about the resignation of Claudine Gay, the president of Harvard University, after only 6 months on the job. A historic elevation cut short by allegations of plagiarism and anger over her handling of anti-Semitism on campus in the aftermath of Hamas's October 7th attack on Israel.
Yeah, also a popular read today. Bill Ackman, you know him well, hedge fund dude who led a campaign to oust Claudine Gay from Harvard, said that the school's board should be removed over its support for the embattled ex-president.
With more on the tumult that has tarnished the oldest and richest U.S. university's brand, it's led to a revolt among its wealthy donors and deepened rifts between faculty, students, and administrators, is Bloomberg News higher education finance reporter Janet Lorin. She's here in our Bloomberg Interactive Brokers studio. Janet, you've had a busy 36 hours after this news broke yesterday. The story today is really about the rifts that are exposed at Harvard University right now and the sort of the interesting way that the Harvard Corporation has a role and the Harvard board has a role. Explain for people who don't understand the structure of the school what's exposed right now.
Well, the Harvard Corporation was 12 members up until yesterday. Now it's 11, led by Penny Pritzker, who used to be the Commerce Secretary in the Obama administration.
This is not the Board of Trustees.
Well, this is this is their Board of Trustees. Okay. And they are the governance of Harvard. They really answer to no one. And they pick themselves, and they picked Claudine Gay. For example, they picked the board of the Harvard Management Company that manages the $50 billion endowment, which, as you all know, has not been performing so well. So it's really up to them to pick also the next president. So I guess the question is, who are they going to pick, and what is that process? You know, we've heard this was the shortest process in many years that picked Claudine Gay. And if you just take a step back and look at the enterprise and look at what the president is supposed to do, two big jobs: keep the ships sailing smoothly and keep fundraising, because you've got to fund it's a $6 billion enterprise. And she performed neither of those roles. As we've talked about many times, donors revolted. Len Blavatnik, who's given almost $300 million to his family foundation a few weeks ago in our story, said he was halting donations, concerns about anti-Semitism on campus. You know, your average rank and file Harvard donor who, you know, may give anywhere from, $100 to tens of thousands to $1 million. They're saying, no, we're not interested in donating anymore. You had people saying, I'm embarrassed to be a Harvard alum. And so fundraising, they brought in over $1 billion every year since 2014. They need that money to operate a huge budget. And then Washington funds 11% of their budget.
I find this fascinating. Talk about this.
So we quoted in today's story Professor Avi Loeb, an eminent scientist. He happened to be in Washington the very day of her testimony, meeting with lawmakers about, a physics project. And that just really underscores that's what Harvard funds, these amazingly brilliant professors and their research. And it's quite a lot of money, hundreds of millions of dollars every year. And you don't want to jeopardize that flow of money. Also, every year, last year, Harvard students got $105 million in federal student loans. Now, we know that they're very generous with undergrads. They're funding, $250-ish million a year on financial aid for undergrads. But, your average Harvard Business School student or Harvard Law School taking loans to cover, $110,000 in tuition every year. It's, you can't really rock that boat.
Well, this is where money complicates everything, right? I thought it was interesting in the story you reminded us that over 700 faculty members supported the president. and vocalized their support for her following the congressional hearing, signed a petition defending the independence of the university, urged its leadership, quote, to resist political pressures that are at odds with Harvard's commitment to academic freedom. I do feel like, Tim, we've been talking about a lot in the newsroom about freedom of speech and academic freedom, which has become tortured, not just in the last year or the last month or the last couple of months, about welcoming different points of view and perspective on campus. And I do wonder how you were thinking about this, not at Harvard, but just more broadly at private institutions, academic institutions.
Well, it's been a huge criticism of Harvard. We had an example in a story we did earlier this year about Stanford's president resigning.
Right.
Don't forget there were research flaws in his work. There was an incident where a conservative judge came in and he was shouted down and couldn't speak, and the school apologized. They were quite embarrassed, and that's just not acceptable, is what they said. You have to have different viewpoints, and when you go out into the real world, you need to understand you're in a workplace like Bloomberg and other places that not everyone is going to share the same opinion. You still have to function in society.
But donors don't necessarily agree, or they're voting with their dollars if they don't. What do you think?
But they do think that there has to be different points of view, and that should not be shut down. And that's criticism Ackman's talking about a DEI agenda, is you have to have different viewpoints, and you have to embrace that diversity of thought. It's not just plain old diversity race, it's diversity of thought and having differing opinions.
Well, Janet, based on your reporting over the last few weeks, was Gay's ouster resignation, would it have happened had these plagiarism allegations not emerged?
It's a good question. I think that the plagiarism pile-on, if it wasn't just one instance or a few instances, people are criticizing the conservative press, but they did a very good job in exposing really what Harvard should have figured out on its own. And it was just,
because she was on the faculty right before.
Yeah, a long time.
Yeah.
And, it's interesting. If you were doing a search for a CEO of a public company, you would have had to figure out, actually, really do a deep dive into somebody's background. And that just didn't happen. I guess it was assumed because she had been given tenure at Stanford and then she came to Harvard. But it, didn't really shake out.
Well, to follow on that, if the academic issues or concerns had come up, or the plagiarism concerns had come up without, that we didn't have
the hearing,
the Mideast tensions or the war, would she have been out on that alone?
Probably not. You can't expect what is going to happen during your presidency.
Yeah.
There's always going to be something that you're going to have to deal with that, it wasn't on your bingo card. You would have never expected it. And you have to deal with things like that. And it just became untenable. It was anti-Semitism. It was how she handled herself in the hearing. One of the criticisms that you keep hearing is students are there to learn. They're not there to be disrupted in their basic econ class when protesters come in. Why was that continue to allow?
If we're worried about their life, if there's tension and stress, right?
There was
threats.
Absolutely. They just want to take their tests and move on. And the majority of students just want to be students and not be involved in a lot of this.
I think about apartheid, go back. I just remember the protests on at Columbia. And if you didn't have some of those protests and pressure put on schools, the amount of important attention that needed to be, drawn to what was going on in South Africa. So, I'm trying to figure out what's the way forward on what I always think in academia, you have to embrace different points of view and be able to protest peacefully.
Hey, Janet, I just want to end with sort of a big picture question here, which is one about context. Why should people who didn't go to Harvard, have no connection to Harvard or the Ivy Leagues, care so much about this story? I mean, every time you write a story about this, it's like the most read story on the Bloomberg terminal.
Yeah.
This is front page news across the country. But Harvard serves a very small number of people relative to the U.S.
And just have about 50 seconds.
They have an outsized influence in the world. I mean, they are the richest university. They can afford a scholarship to be looking at the most important problems. Look at how many Nobel Prize winners come out of there. Really important thinkers. They have the means to do really important work. And, you don't want to get sidetracked. Again, you don't want Avi Loeb's funding to be threatened for, the most important physics problems that the world can benefit from because of, decisions that have really united Congress against Harvard. There were 80 Democratic Congress members joining Republicans to condemn their testimony. How does Harvard unite the Congress, against them? And don't forget, you have the left and the right. The left was upset about legacy admissions too.
Unbelievable. That's right. Read Janet's story. It's among the most read. Bloomberg News higher education finance reporter Janet Lorin. Janet, thank you.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're going to switch gears a little bit, talk a little bit about the healthcare world. According to the Centers for Medicare and Medicaid Services, U.S. healthcare spending grew 4.1% in 2022 for a total of $4.5 trillion. That's about $13,493. Sorry about that.
I saw that number.
Per person. That's a lot.
It is. We spent when you have a kid.
You spend a lot more.
Yeah. When
Major
the
surgery,
birth of a kid.
You spend a lot.
I was like, we spent way more than that last. Well, fortunately, we didn't. Our insurance company did.
Yeah, but, exactly.
Carol, spending on healthcare accounted for 17.3% of U.S. GDP. Needless to say, there is a lot of money in healthcare.
Our next guest comes to us from WellSky. It's a B2B tech company. It provides tech services for healthcare providers, insurance companies, social services providers, and a lot more. It is backed by the private equity firms TPG and Leonard Green and Partners. The company, Tim, has a great read on the money flows throughout the complex healthcare ecosystem and where efficiency can be found. I'm hearing IT spending.
Yeah, Amy Shellhart is Chief Solutions Officer at WellSky. She joins us on Zoom from Springfield, Missouri. Amy, Happy New Year. How are you?
Thank you. Happy New Year. I'm great. Ready for wonderful 2024. Thanks for having me.
So explain for the layperson what exactly WellSky powers.
Well, WellSky powers, as you said, technology, services, and analytics that support over 20,000 clients. And to sort of put that in perspective, it's about 2,000 hospitals, 130,000 providers. If you think about care being provided in the home, it's 1 in 3 home care-based providers utilize our system, over 5 million caregivers. So a lot of the technology, again, the services, and the analytics that help them do their jobs every day.
Well, I said to our producer this morning when we were getting ready and prepping for our show, and we were talking about your company and you coming on, I said, so it's like back office. Is that what it is? Or is it infrastructure, tech infrastructure?
It's actually all of that, right?
Okay.
So when we think of back office, we think of things that power the operations, right? Think of a home health agency, a back office is how do they do scheduling? How do they do billing, right? Those pieces, our solutions do those, but also how do they deliver care in the home? How do they engage with patients via telehealth or video visits? How do they determine how to assess a patient and what types of content that they need to provide the patient from an educational perspective? We run the full spectrum of all of those, both in home as well as in specialty care areas like LTACs and SNFs, in home infusion, really all of post-acute care. And our solutions also power discharge planning in hospitals as well.
So talk to me about what you're seeing from the hospitals, from the insurance companies at the end of last year and going into this year. I mean, Carol said IT spend. It's certainly a big part of this. How is spending right now?
Well, it's a huge piece of it, right? As you mentioned, healthcare spend really in our country continues to be something we're all challenged with. I think what we're seeing from our providers is they want to make sure as those spends increase that they're getting more ways to augment and support their very limited staff. And so that if sort of thinking about the trends of what are our clients saying, look, their most costly expense is their staff, and staff are becoming harder and harder to come by. We're seeing shortages both in skilled and non-skilled care. In fact, in the next 5 years, we're expecting to see a shortage of 3.2 million essential low-wage, healthcare workers. And so they're really looking to us as technology services and analytics providers to help them with technology solutions that allow them to work with less people, but process more patients. So if you ask, what's happening as we look at from last year coming into this year, we're still seeing our healthcare systems, heavily utilized. still dealing with large, volumes of COVID patients. We're seeing increased discharges to skilled nursing facilities, increased discharges to home health, which means that patients are coming out sicker. They're not able to just go home on their own. They're needing to have follow-up care, skilled care, either again in skilled nursing facilities or the home. So a lot of pressure on the healthcare system in general.
What's cool with talking about this with someone like yourself, your title is Chief Solutions Officer. So you're obviously working with companies to kind of figure out how you guys can help them with some of their back office or IT spend and needs, if you will. Having said that, Amy, we're at this interesting point, new year, we're kind of thinking and trying to figure out what comes ahead. There's a lot of questions about that in terms of the economy, what the Fed does, how that impacts growth potentially. So having said that, IT spend is always an important indicator, we always feel. How would you compare the IT spend and what you're getting from some of the clients that you work with in figuring out solutions? Is it going down compared to, I don't know, what's the smart metric? The past 6 months, the past year? Is it slowing down? Are companies thinking really hard before they do an additional IT spend right now here on January 3rd, 2024?
That's an interesting question. We are seeing more scrutiny. So I think to that point, we are seeing more scrutiny of the spend. We're being asked to deliver more outcomes and value, which frankly we embrace. And what I mean by that is they know they have to spend the dollars because they have to solve these problems, like these staffing shortages problems and the higher volumes of patients that they're seeing. So what they're saying to us is, as we spend this money, we want, in some cases, shared risk. So tell us what kind of outcomes we're going to achieve with your technology and go at risk with us so that if those outcomes don't emerge, you have a little bit of skin in the game. We see longer cycles for making decisions. We're seeing some of that, longer decision-making cycles. But I would say in general, they're still spending money. They're just being more scrutinous in terms of what the expectations are, I think in a really good way.
Not in a recessionary way? Just quickly.
Yeah. I think I will tell you that while we have seen the cycles take longer, we're still having those effective sales processes.
Okay.
But the conversations are getting tougher. And again, I will give them credit for that. Conversations getting tougher around show us the outcomes, show us the ROI.
Great context.
The ROI we're going to get. Yeah.
That's very interesting.
That's interesting.
Yeah. Amy, thank you so much. Amy Shellhart, Chief Solutions Officer over at WellSky, joining us on Zoom from Springfield, Missouri. Conversations on IT spend getting harder. That's my thought for the day. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, Tim, getting ready to wrap up the second trading day of 2024.
What a year, Carol. What a year.
Can we do that already?
Market's down for the year.
Are you ready to make a call?
I'm ready. No way. Never. Saw how that worked out last year for all those analysts.
You're like, I think I'll wait a little bit.
Yeah, not going to happen.
All right, we are, though, definitely seeing continuation of some selling here. NASDAQ, as you just heard from Charlie, the worst on a percentage basis, down about 1%. So let's see what our guest has to say. Let's get to the drive to the close. Dave Donabedian is CIO over at CIBC Private Wealth Management, joining us, back with us on Zoom from Baltimore. You shared with us, first of all, Dave, Happy New Year. Nice to have you back with Tim and myself. In the notes that you shared with us, when we look at the economy in 2023, you point out it really did exceed expectations on all fronts. It's not exactly the playbook everybody was predicting a year ago now, or at the end of 2022, heading into 2023. Everybody thought the world was going to come undone.
Right. I mean, the consensus forecast, particularly for the second half of 2023, was for a recession. The idea being that we had a significant tightening of monetary policy, an inverted yield curve, a big decline in the index of leading indicators, et cetera, et cetera. And of course, it didn't happen. and the economy certainly performed above my expectations. I think the question now is what happens next. If you look at the consensus view, it's almost as if a lot of the people who thought there was going to be a recession last year, when it didn't happen, just said, oh, well, I guess we're not going to have a recession ever. I hope that's true, but it's not likely. I still think that this coming year, well, now this year, 2024, I don't know if it'll be a recession, but I think it's going to be a year of kind of stagnation to very slow growth, slower growth than we've seen in any of the prior 3 years. And I think maybe that's one factor that the current, kind of very rosy scenario pricing of markets isn't taking into account.
So do you think there are further declines ahead as a result of the way that you think the economy is going to move in 2024?
Well, look, we finished the year up 9 weeks in a row to close out 2023. So at a minimum, we're due for a breather, and we're seeing that here over the last couple of days. But I do think when you have an equity market priced at 20 times forward earnings, and when the earnings are probably too aggressive, you're due for a bit of a pullback, and so it wouldn't be surprising to me that we see that unfold here in the first few weeks of the year. I do think, though, that the biggest occurrence we're going to see this year, and maybe it's not until later in the year, though, is what I call the conditions that will set forth a multi-year sustainable bull market. I know a lot of people use the word bull market or the words bull market to describe last year. And I realize someone somewhere long ago decided if the market goes up 20%, we call it a bull market. To me, though, we're still on a sort of a round trip journey. We're at the 2-year anniversary of the all-time high in the S&P 500, and we still haven't kind of quite recaptured that yet. But I think as 2024 advances, we are going to begin to get those rate cuts from the Fed. It's going to be clear that it's not going to be one rate cut. It's going to be a progression of them. And that's typically been a green light for what I'll call a real bull market, where you move to sustained and repeated highs.
What about the move that we saw in small caps late last year, kind of breaking out, right? We did see a broadening of the rally, which was healthy, most would say. But I'm looking at the Russell today is down about 2.6%. So really taking it on the chin. And that to me speaks to maybe some concerns about what could happen here in the U.S. economy this year. And if we get a Fed that overdoes it and turns us into some kind of a recession, what are you advising to clients at this point? Should they be going after the winners of late last year? Should they be broadening out, looking at those undervalued names? What do you suggest?
Yeah, I think broadening out, and we're pleased to see in November and December. All right, the strong market rally wasn't all about the Magnificent Seven. We had very, very broad participation, including and especially, as you point out, in small caps. So our message is that you could argue diversification didn't work in 2023. The best performance was being clustered into those handful of stocks. I think it will be more important, and we will see, if you will, sort of broader prosperity across markets, including small caps. They're getting hammered today, but the valuation differentials there relative to large caps are pretty extreme, even with the small cap rally that occurred late last year. And you're right, economic weakness can be a concern for small cap investors above others. But small caps also love rate cuts more than any other part of the market, and that is to come. So we actually kind of like the small and mid cap sector.
So you think the rate cuts haven't necessarily been fully priced in? That's what I'm hearing from you.
Well, I think there's a little bit of a divergence, right? The Fed has led us to a 75 basis point expectations. Markets are saying now twice that. We're going to see 150 basis points of rate cuts. 150 basis points of rate cuts, to me, only happens if we get the economic scenario I mentioned, where, in fact, at least concerns about recession kind of creep back into the market. I think that's going to happen. And so I think we'll see at least 150 basis points of rate cuts this year. And more than 150 certainly isn't in the market. And, we kind of had the FOMC minutes today saying the opposite, which is, you might be getting ahead of yourselves if you're looking at, twice what the dot plots say. So it's going to be as always, it's going to be data dependent.
Well, that's what I was going to say to you. I mean, and we're asking you to kind of make some calls here. Having said that, the first Fed meeting is January 31st. Then we've got one March 20th. But I do feel like we all kind of have to slow our rolls here because there's a lot of different scenarios that could potentially play out in terms of Fed policy, in terms of geopolitics. We haven't even brought into the U.S. fiscal situation. We've got a November election. I just feel like there's some significant.
That's it?
I'm already like, okay, bring me to 2025.
Well, I mean, you raised a really good point, Carol. I mean, David, what do you think is the biggest risk or the biggest sort of thing that you're looking at this year?
In just about 30 seconds.
Right. I think it's that economic growth does not achieve expectations, which means that profit growth doesn't achieve expectations, and that could take a multiple point or two out of the markets before we get let's call it the benefits and the positive sentiment around Fed easing.
Sounds
so
like
it could be challenging.
Yeah, so even anemic growth, right? It might not be technically a recession, but it's going to feel like one, especially when prices maybe not going up, but they're still at high levels. We have to remember that. Hey, Dave, thank you so much. Dave Donabedian, CIO over at CIBC Private Wealth Management, joining us on Zoom from Baltimore.
I thought he was going to say the election.
I know. It's a big deal, I think.
Very big deal.
No doubt about it. All right, everybody. This is Bloomberg Businessweek.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.